You can all go to sleep now because this is the economics session. I have to say, I never get invited to dinner parties. And the reason why I never get invited to dinner parties is probably because a lot of my messages tend to be, well, I'm an economist, you can see it one way, you can see it another way, and we're probably going to hell in a handcart anyway. So what I'm trying to do today is to give you a little bit of an economic narrative that I hope you will find relevant to your sector. And that really gives you an idea of why economists at the moment can't be relied upon to give you any evidence at all. So let's have a look at the hotel sector. The way I've looked at this, I think it's fair to say that Leo did a very good job of explaining that the whole world is in balance at the moment, but teetering on the edge of some really strong, I think the IMF call it headwinds. So if we have a look at the hotel sector on one side of my seesaw, 2017, according to the PwC reports, a very positive year. 2018 may be looking slightly weaker, but there are still some very strong signs there. And UK travel has actually become a very strong export sector. So if we look at the things that the UK is exporting and exporting well, then travel is one of those things. And that, of course, has consequences for this sector. But if you then go on and have a look at some of the things that are happening in the UK environment and the global economic environment as well, it's a little bit more worrying. And the IMF have done their best over the last couple of days to present as negative a picture as they possibly can. But in the UK itself, we're seeing GDP, it actually is okay, but it's pretty flat. Same thing with flat real wages, and the problem with flat real wages means that we tend to borrow more in relation to our wages, and I'll come on and talk about that in a minute. But perhaps the biggest thing that's in our market at the moment, and in the economic market at the moment, is this perception of risk and uncertainty. Now, economists are fairly comfortable with risk because it's something that you can insure. It's something you can say, well, there's a probability something's going to happen. But as soon as that starts turning into things that are uncertain, then investment decisions start being held back. Then decisions about how many people to employ, how much money to allocate, start being held back. And that is affecting our consumers more than anything else at the moment. So the biggest risks are actually that this uncertainty stays as uncertainty, because then we don't know what's going to happen. And it tends to mess up economic models. So why is this particularly an issue for the sector and that we're all here to talk about today? Well, it's an issue on the supply side to some extent, because as far as I have read, there are new sites being built. There's a lot of confidence out there that there are new ways of doing things. Sterling has been relatively weak up until the last 6 months, and so that's meant that actually it's been very positive for the sector, for people coming in, larger numbers coming into the UK than ever before. And we've seen that strong growth in tourism that I see in my trade statistics and that the government has acknowledged. But there's a danger with all of this growth and all this positivity that particularly came from 2016 through into 2017, that we're over-investing to some extent. We might have under-occupancy beginning to creep in, and that's obviously a big concern because it then means you don't get the occupancy rates, you're not profitable anymore. And so the real way of looking at this is actually to look at consumer demand and to look at what's happening to the people that buy hotels space and buy holidays and breaks. So in terms of where we are on the demand side, if you think about a few certain things like interest rates, well, interest rates have started to tick up. And that starts to make people worried. Why does that start to make people worried? Because the country is, and the consumer sector in particular, is highly indebted. We're still seeing levels of unsecured borrowing go up by about 8.3% a year. That's very high. Sterling is getting a little bit stronger. There's a lot of volatility priced into the markets at the moment, so we can't tell. And if you talk to businesses on the ground, whether in this sector or anywhere else, but particularly in this sector, the risk of currency being too volatile is actually one that the sector is very worried about. And I run surveys. I've got a sample of about 5,000 companies. Good chunk of them are in this sector. And this sector is the one that's most worried about currency instability. But then the other thing that's interesting is actually the effects of terrorism and the effects of political instability, because it gives a sense of a country not being open for business anymore. And one of the things that we are seeing in some of our models is an increased threat perception as well. So something out there that's creating the UK as an environment where, you know, security is perhaps a little in question. So I will come onto that in a little while and show you some numbers. But the biggest thing to say around demand at the moment is that climate is uncertain. People aren't completely sure what's going to happen. So let's start with the economics of GDP. I think it's fair to say that if you're an economist, you can prove anything at the moment. The reason for that is if you look at this chart, you can see that GDP has grown, well, very rapidly after the financial crisis to the end of 2010, 2011. And since then, it's actually ticked along at a relatively flat rate. If you look at trend growth over that period of time, it's been relatively flat. So you can look at the recent upticks in GDP, or you can look at the period since the Brexit vote, and you can say, well, we saw quite a sharp increase in growth after the Brexit vote. Then it slowed down again, then it's ticked up again. You can prove anything. The truth is that since the financial crisis, GDP growth has been relatively flat. And if you look at where we were pre-crisis, we're actually at a very similar level still. So what's interesting about that is you'll hear lots of economists on either side of the Brexit fence, for example, saying, we think this is happening as a result of Brexit, or we think that's happening as a result of Brexit. Truth is, at the moment, in GDP terms, we don't know. We don't know what the Brexit effect is, largely because we don't know what Brexit is likely to entail. Now, this chart, I think, is absolutely fascinating. It looks like it's one of the most boring charts out because you've got 2018 and 2017, 2019 compared. This is the average of all of the independent forecasts for growth over the next year, for unemployment and for inflation. So you think of how much money has been invested in that chart. Just have a think. All the independent economists out there, so you're looking at all the bank economists, you're looking at all the independent research organisations, and they've all been pulled together by the Treasury. And what are they showing? Not much is changing. Excellent. So, I mean, a lot depends on short-term factors at the moment. And I think, though most economists, and including the IMF over the last couple of days, are predicting that the UK economy is going to slow this year, actually they're predicting a slight uptick next year. But we don't know. Because, again, Mark Carney said only a few weeks ago, it might well be that the economy falls apart after Brexit. There might be a mass capital outflow, there might be a collapse in the value of sterling, and house prices might fall by 30%. And if all of that happens, then the consumer, in the middle of all of this, is very uncertain about how to spend their money. Again, to go back to the point, we don't know at the moment. And because we don't know, this is again creating uncertainty, particularly for the consumer in the market who has no idea whether or not the interest rates are going to go up, whether or not they're going to see more money coming into their bank account, and whether or not they're going to be able to afford their leisure. The other thing is the case with inflation as well. So one of the big things that drives consumer demand in the UK is house prices. Now, if house prices are going to go down by 30%, that alters consumer behaviour considerably. So that piece of forward guidance from Mark Carney is something that we perhaps need to be concerned about. But why do we buy leisure? We buy leisure because we want time out from the workplace, and we buy leisure because we have some money to spend on it. Actually, 24% of our weekly household income is spent on leisure activities. So hotels are about 9% of our weekly income on average is spent on hotels and travel. then that helps explain over the last few years why things have actually looked quite good. But now we're seeing owner-occupied house inflation falling. In other words, house prices aren't growing at the rate that they were. And the housing component to what we're spending each week is falling back. Now, that might actually mean that there's some uncertainties in the housing market that are, again, creating some difficulties for UK consumers. But this could also be because the market is changing anyway. We're seeing an older generation of people owning their houses, younger people aren't owning their houses. And again, you've got big changes in consumer demand. It's not necessarily a Brexit effect there either. But let's focus on that borrowing a little bit more. As I said earlier, 8.3% growth in borrowing, unsecured borrowing at the moment. So, in other words, banks and non-banks, credit cards and so on, are lending money on an unsecured basis at a growth rate of 8.3%. Inflation is currently 2.7%. Real wages are growing by 2.2%. In other words, we are borrowing far more than we can afford to pay back relative to the amount at which our wages are growing. And that means that eventually our spending is going to get squeezed. It will have to. It's the lowest income groups that are borrowing more proportionate to their income. But there was some very interesting work that the Bank of England did, which said, well, actually, it's the people in this room, potentially, it's people like us who have high credit scores, they have mortgages, and they have credit cards, and they have income. But what they're doing is they're actually borrowing to restructure their debt all the time and just kick the financial can down the road. Eventually, that chicken has to come home to roost. Eventually, you have to see the borrowing that people are undertaking now, particularly if it's unsecured, paid back. And that's why we're beginning to see that type of uncertainty in the market creeping in as interest rates start to tick up. And Mark Carney has already said the Bank of England will not be able to put up interest rates or have an interest rate lever as such if the economy goes into free fall after a no-deal Brexit. Again, we don't know. It's this uncertainty that's there. But let's have a look at why this is important. It's associated with low real wage growth. So if you look at the charts here, what you've got is nominal wage growth versus real wage growth. And you can see that nominal wages, i.e. what you think you've got in your pocket, is going up very slightly. That's the light green line. The darker green line is real wage growth, which has been very flat. And it's been very flat since the financial crisis. And it's less than nominal wage growth. So what you actually have in your pocket isn't growing as much. Now, again, some months they say it's growing more than inflation, some months they say it's growing less. But since 2014, we've seen this crisis in borrowing because real wages aren't growing up. People aren't going up. People are borrowing because their incomes are lower and not growing. And that has a real impact. So let's have a look at the average expenditure per week per person. £554.20, the average consumer spends a week. And I've broken that down in terms of what types of products consumers buy. But let's have a look at what that number actually is. £554.20 a week. If we gross that up, it comes to £28,818 net. Now let's add all the tax and national insurance and everything on top of it. It's an annual income of about £40,000 in order to spend £554.20 a week. Average income is £27,000. What that means is that we've got a gap. Borrowing is untenable, and it's going to affect all of these areas eventually of expenditure. But look at the ones that are most vulnerable. And it's probably that 24% that we spend on entertainment, that we spend on hotels, that we spend on travel, that we spend on our leisure time. We can see over a period of time that that demand is likely to get dampened. And add to this the political uncertainty that we've got in the world. And if you look at social media data, if you look at news data, which we do, we have a metric that does this in my technology company, This model has been saying for the last couple of years that actually some of the news feeds that we're getting and some of the political analysis that's coming through is suggesting that the UK is a riskier place to be. That feeds through into a public perception about the risks that are out there. Whether or not the risks are there, there's a perception, as we were looking at earlier, trade wars, what happens? It makes the world feel as though it's a very uncertain place. And the anxiety with all of that, my slides have gone. Help. Can I have my slides back? Okay, I've gone there. I can't see them down there. I'm going back to the lectern. So the risk with all of this is that actually, while we don't have very high levels of corruption, everything's out of 100, we don't have very high levels of external conflict, we don't have very high levels of foreign policy concern, but if you look at internal conflict, it's growing slightly, but the biggest ones that are growing are the threat of terror and the impact that terrorism has had on the way in which we run our economy and run our society. We're very different to how we were 4 or 5 years ago. You know, the See It, Say It, Sort It campaign, we're conscious, we're made aware of all of that all of the time. And it creates a general risk. It's not just the UK, but it is something that from all the media searches and all the social media that we're monitoring is something that's picking up as a concern. It's something to be aware of that might affect demand in the future. So all of this leads economists perhaps to be thought of quite a miserable bunch, and everything is fairly miserable. And we might conclude from all of this that 2018 looks quite risky. The political situation is creating some difficulties at the moment for making decisions in business. And the economic growth that we might or might not see at the moment is fairly questionable because of the uncertainties that are out there, but also because we're not going to see significant upticks in growth over the next couple of years anyway. So we could conclude from this that actually things are pretty awful and the sector has some real demand-side risks attached. But then let's have a look at what the businesses say. So I looked at the trade patterns and looked at exports. And as I said, we saw over 5% growth in trade between 2016 and 2017 in travel and tourism. Now, that's actually very high because if you look at UK growth in trade overall, it was only 1.2%. So travel's growing more than average for the UK. And travel now exports $43 billion worth every single year. And we're seeing a growth pattern as well. So we're looking at it growing above trend over the next 3 years. If you then go and talk to businesses, and as I said, I run a survey on behalf of Santander for this, 63% of businesses in this sector expect their companies and their businesses to grow over the next 3 years. And they're not just confident, they're very confident about growth. So for all of the economics that's out there, these are risks that are being managed and being managed very confidently by the sector. And 46% of the sector said that they actually improved last year, so their business performance improved last year. And then if you look at results and look at survey work that other companies have done, we had a big spike in 2017, and although analysts are looking at some kind of a slowdown perhaps into 2018, there was a spike in 2017, which means that growth is inevitably going to be slower in 2018. And the projection is still positive, and it's still above trend. So there's a lot to be very optimistic about on the economic front for the sector. So I guess what I would say is, from a business perspective, and I run a business too, don't worry too much about the data, which is a terrible thing to say for a data company, isn't it? But data and statistics, and particularly public statistics, are there as an evidence base to make people's minds up, to give them some kind of a framework, but you can interpret them in any way. What's important is actually what companies are saying, and there you're seeing growth and you're seeing a lot of positive thinking going on as well. There are undoubtedly some challenges ahead, and it would be very wrong of me to suggest anything else. Workforce and skills in the run-up to Brexit, big challenges for the sector. Perceptions that the UK has become more risky, and potential for consumer demand to slow. Those are all big factors. But the businesses in the sector are confident, they're expecting to grow, and the important thing about uncertainty is to turn it into risk, which has a probability and which can be managed. Thank you very much.